Good morning, everyone. Thank you for joining us for our fourth quarter call port trends webinar. My name is Andrew Palillo. With me today is John Kornacki, and we're delighted to have you with us as we walk through what's going on in the markets, what's going on bank and credit union balance sheets, and some of the levers that we can be pulling looking forward. We're going to jump right in. We have a lot to cover. Hopefully, you'll find it of value. So I'm going to pass it over to John as he's going to take us through what's going on with rates and the economy.
Thanks, Andrew. Good morning, everyone. Thanks for joining us today. We're going to start off by talking about interest rates and the economy. A few different topics here to cover. Starting off, we're going to look at various short-term rates. Over the last quarter, we've seen pressure on the front end of the curve. Of note, the overnight rates have drifted away from the midpoint of Fed guidance, with SOFR as low as 2 basis points last week. A lot of that has been driven by the drop in expectations for cash at the General Treasury account. It's expected that the cash position at the central bank will return to more normal levels, expecting a decrease of about $500 billion in the account by mid-year. So all of that cash will have to go back into the market, which could potentially drive short-term rates even lower. This is something to keep in mind, and we're going to touch on this in a little bit as well in our strategies section. On this slide, we're looking at total assets at the Federal Reserve, as shown by the blue area and left axis, and also total reserves at depository institutions, shown by the green line and right axis. The Fed continues to provide some direct and indirect support to the markets, with the Fed purchasing roughly $120 billion in MBS and treasuries every month. This is creating a challenging environment for depositories. Many depositories have chosen to stay in cash rather than reaching for yield in the credit markets, as shown by the rise in total reserves at depository institutions. You can't talk about the economy right now without following vaccination progress and the hopes that things will return to normal by mid-year. So you can see in the left chart here, this is the percent of folks that have received at least one dose of the vaccine, as shown by the blue bars, and the percentage of folks that are fully vaccinated, as shown by the green bars. We're still far away from reaching critical masses, but it does show that there's a light at the end of the tunnel, for the real economy at least. And then in the chart on the right, we're looking at rolling 7-day daily vaccinations. Ideally, we'd like to see this more of an upward slope, but logistics and distribution has been a major challenge for federal and state governments. So hopefully we'll see this continue to trend positively and allow us to return to normal by mid-year. Going back to rates for a minute, this time focusing on longer term. Much like the third quarter, the curve is steeper. You can see the trend in the 5-year Treasury, as shown by the light blue line, which is more relevant for depositories. We've seen that climb 20 basis points since September. So there has been some relief there, even though historically we're still looking at very low absolute rates and a much flatter yield curve. And then if you look at the chart on the right, we're showing the change in the 5-year Treasury versus 5-year classic advance rates. As you can see, our classic rates are only up 7 basis points as spreads have tightened over the last several months. And this is good news for those of you that are contemplating borrowing from us in the near term. Not so much those that are pricing assets off of this base. So we're now looking at inflation expectations. This chart is showing the 10-year break-even rate, as shown by the green line, and the 10-year Treasury rate, as shown by the blue line. With long and nominal rates higher, looking at this alongside inflation break-even rates via tips is very useful. So this chart is going back to 2009, and the real takeaway here is that the last time break-even exceeded nominal rates like this was back in 2013, which preceded the taper tantrum. But if we look at this from today's lens, the Fed has been adamant about letting inflation run hotter consistently above 2%. So they may be willing to let long rates keep going higher as long as it's orderly and credit, equity, and funding markets are all operating smoothly. Okay, so if we take a look at the markets I just mentioned, those markets are all doing just fine right now. Starting at the top left, you can see short-term funding is calm, as shown by the TED spread, which is well below the 5-year average and near record lows. Moving over to the right, credit has seen a massive recovery as shown by the BBB corporate index spreads. And then looking at the S&P 500 since April, not much to say here other than stocks continue to go up with very little volatility in recent months. And then the last chart here is looking at interest rate volatility. This has come up over the last few months, but this is consistent with a steeper yield curve. So there's no signs of turmoil as of yet with interest rate volatility. With all of these, we don't see a lot of stress in the market right now. Moving on to mortgage rates. As we discussed last quarter, historically the 10-year Treasury rate drives mortgage pricing, but that hasn't been the case in recent months. The long end of the curve has come up, but mortgages, which are the primary exposure to that part of the curve, have gone the other way. You can see in this chart how the fourth quarter drift in Treasuries saw mortgages go the complete opposite way. And even with the steepening in the first quarter of the year, mortgages have ticked higher, but to a much lesser degree. Now, if you take the components from the last slide and look at it in terms of spread, you see the results. With Treasuries rising and mortgage rates going down, the spread has collapsed. And we've seen the spread tighten by over 100 basis points since the second quarter of last year. And back in the second quarter, credit and liquidity uncertainty really contributed to that spread, but neither of those ever materialized. We've been strong advocates of holding fixed rate mortgages given all the challenges occurring, and hopefully you took advantage of that. And anecdotally, we heard from folks that they are holding more fixed rate mortgages, but right now that's largely been driven by the persistent high cash levels and not so much the spread attractiveness. And then looking at the chart on the right here, we're looking at Fannie Mae commitment yields versus 7-year Treasury. Fannie Mae commitment drives investment yields, so you can see that the spread tightening has muted the backup in Treasuries. So unfortunately, we're not seeing better yields right now, even with the recent steepening. So now looking at unemployment levels on the left chart here, we're showing peak unemployment levels during the pandemic for each state as shown by the blue bar, the December unemployment level as shown by the green bar, and then the X's represent January 2020 levels, which is pre-pandemic. So unemployment has thankfully come back down from the extremely high levels we saw last year. And if you look at it at some of the northern New England states here, you actually see a return close to pre-pandemic levels, with some of the northern New England states, however, still having some room to snap back. And then if we look at the chart on the right, this is looking at anonymous Google Maps data for New England states. The chart in particular is focused on retail and recreation, which includes places like restaurants, cafes, shopping centers, theme parks, etc. So the latest value is a comparison to a baseline value, which was chosen as a time period of January 2020, which is pre-pandemic. And so as you can see, traffic to retail and recreation crashed in the first quarter during lockdowns and has seen varied recoveries across different states. Similar results to how you look at the unemployment data, where northern New England states have returned to a more normal level compared to others, especially when you look at Massachusetts, you're still showing 12% below baseline. So with that, there's some mixed results, but still positive trends that we're seeing, and hopefully this will continue going forward. So right now, I'm going to turn it over to Andrew to talk through some call report trends.
So if we look at the first slide, it is this is what I call the Captain Obvious Award, where what is staring us in the face right now, and it's the level of excess cash sitting on balance sheets, really at unprecedented levels. And as we look at across our membership, ranked in ascending size from our smallest members all the way up, we do see a little bit of a trend where there's a negative correlation between higher cash levels at the smaller institutions, but the level of cash, even at some of the larger banks and credit unions, is still significantly higher than it's ever been. One way to consider that is looking at the smallest 100 members back in Q4 19, and we're going to refer to Q4 19 a number of times because that is our
pre-COVID, quote unquote, normal baseline. And back then, our smallest 100 members, so basically everyone under about 200 million or so in total assets, was at about 7.5% cash. Our largest members, our largest 100 members, so essentially everyone $1 billion and up, at the most recent quarter had over 8% cash. So pretty exceptional to see, that switch between the smallest and the largest. If we go to the next slide, how and why has cash built up, and we'll get to what's going on with deposits in a second. Certainly that's been a driver. But let's look at what's happening on the loan activity and growth side. And one of the things that we're hearing from many folks is that, there's activity, but it's more kind of spinning the wheels and maintaining balances as opposed to new growth. And that really stretches across, most of the different subsectors. Part of that is attributable to the high prepay activity. What we did as we dug a little bit deeper into the numbers, we want to see, what percentage of members were able to grow certain loan categories quarter over quarter, and if there was anything noticeable or different currently versus we have seen over the past few quarters. And interestingly, other than banks and residential loans, residential mortgages, where there has been a concerted effort to reduce that exposure, combined again with that prepayment and the spinning the wheels, if you will, the percentage of members who had quarter-over-quarter loan growth was largely in line. So whether you're looking at banks and CRE or credit unions with resi loans and auto loans, when we look at the bottom table and we see, in aggregate, the dollar amounts, we tell a little bit of a different story and more intuitive. And what we all kind of see and hear out there right now is that in aggregate, the growth really isn't there. So we see the comparison of fourth quarter 19 versus fourth quarter of 20, the shrinkage in the resi exposure for banks. The CRE growth pales in comparison to what it was a year ago. Credit union growth in residential mortgages has been strong, but still a few ticks lower than where it was a year ago. Autos for credit unions is the exception, and maybe that's a little bit of a glimmer of green shoots for a recovering economy if folks are looking to buy cars to drive to jobs, which necessarily wasn't always the case. Looking back over the last year. Flipping to the next slide, again, staying on the theme of loan growth and loan activity. So, we have some proprietary analytics that we put together that helps us understand member balance sheets a little bit better. So we put together something called the loan quality. It essentially looks to, identify the quality of the lending franchise. So, looking at key metrics like, are you able to produce a lot of loans given the size of your balance sheet, loan to asset ratios, and those loans coming on, are they high quality? So looking at the credit performance and are they of relatively high yield, and are you able to preserve those yields? So, when we separate those members who have top quartile loan quality scores and compare them to the median member and say, are they holding higher levels of cash, and have even those folks with the strong lending franchises, have they been able to grow loans? And we do see a little bit of a difference. And we see that the high loan quality score members have been able to hold less cash and show more loan growth. Now that growth pales in comparison to what it was year over year, even when we back out the effect of PPP. So when we look at how these members have lower levels of cash, there's two ways to look at it. One is looking backwards and one is looking forward. So looking backwards, you can say, okay, well, they were able to scrounge up more loans and deploy some of that cash. But the other side of the coin is and one thing we're seeing and hearing from a lot of folks is that they're hoping and expecting a snapback in the second half of this year as well as beginning of next year in loan growth and demand. That these high performing lending institutions aren't necessarily holding cash to higher amounts for this anticipated level of loan growth. And, John will walk through us in the strategy section about some of the ways to balance that. How do I reduce my excess liquidity today, but also how do I accommodate and account for the potential for accelerated loan growth? So at this point, we're going to pause and do a poll question. what percentage of members saw margin growth quarter over quarter? Okay, so the majority of folks said 32%. The correct answer is 53%, which 21% of you voted. And there's an asterisk there because this was kind of a trick question. So those of you who voted 41%, hang in there, and we'll explain what was going on there. So looking at what margins have done quarter over quarter, we see a little bit of a shift in the trend that the median bank member was able to see margin expand by 10 basis points, and credit unions was down by a basis point. But in both cases, what we had seen over the previous 2 quarters changed for the better. If we go to the next slide, this is where that asterisk from the poll question comes into play. So what we saw in the fourth quarter, more predominantly on the bank side than the credit union side, was the start of the PPP forgiveness process. And so if you look at the table on the bottom, this is a walk or a progression of net interest margin quarter over quarter for an example member. So in this case, this member was able to see 6 basis points of margin exposure. But when you break out the components, you can see the significant effect of the PPP income contributing 14 basis points of accelerated fee income coming into margin. And that was far and above the impact of the drag of the excess liquidity as well as the repricing of asset yield, but also the benefit of the cost of funds. And you can really combine the excess liquidity and the asset yield into one, because that's a conscious choice to keep the level of excess liquidity. And this is where there's concerns about, the question on the prior slide of have margins bottomed. And so, if we look at the top and see, where are yields or costs, for the big balance sheet categories right now, and where is the marginal dollar, and what is that costing right now? If you look at cost of funds for both banks and credit unions have come down considerably at below 50 basis points. But you look at the impact of the marginal dollar of funding and where that comes on. So whether it's a deposit or a wholesale source, it's probably going to be below where your cost of funds is now. But that differential really isn't too extreme. Compare that to what's going on the loan side, where yields are around 4.25, and depending on which bucket of loan type you're looking at, that dollar at 4.25 coming off is getting replaced at yields well below that. Probably into the 2s or 3s, for the most part. So I think looking forward, the asset repricing drag still has some room to take effect when you back out the extraordinary impact of the PPP income. When we dig into the margin impact, we also like to look at the differences across our footprint here in the New England states, and we do see some interesting things. When we break it out on a state-by-state basis, and we see our members in Maine and Vermont have been able to maintain strong margins, largely driven by the ability to keep loan yields significantly higher. Connecticut members have done a very good job of getting cost of funds way down low, 37 basis points in the most recent quarter for Connecticut members. And Massachusetts and New Hampshire, in aggregate, have garnered more support from investment yield, helping counteract the contraction in loan yield. So we talked about the impact of the PPP forgiveness starting in the fourth quarter, but now, as many of you are aware, we're into PPP round 2. And some of the takeaways, for the activity that we've seen and heard thus far, that it's about 20% in terms of the total dollar amounts that have been distributed. But when you look at lender participation, it's about 90%. So most institutions who have been participating in the program have come back, but the total dollar amount, still pales in comparison. And certainly, as we talk about excess liquidity and the experiences many had with, the PPP loans came on the book, but in many cases, balances stayed in non-maturity deposits. That is certainly going to play an impact on the liquidity side of things. Continuing with the liquidity theme, and we talked a little bit about, the challenges on the asset side. Well, the deposit side, as many are well aware, deposits have surged and they've continued to surge. And when you look at the makeup of the deposit side, the amount of total liabilities comprised of core deposits. It's considerably improved and strengthened year over year for banks and credit unions. Credit unions exceptionally are just at about 98%. One interesting thing to take away here is that, it seems like for banks, more of those deposits have flowed into non-interest bearing deposits. And in fact, MMDAs are down, very slightly over year, where for credit unions, there was the growth in the MMD and the savings, and as well as in the non-interest bearing. With that growth in greater reliance on non-maturity deposits, the odd man out is the what's going on with term deposits. One of the takeaways here is that, much like many other things going on in the industry and the economy and in our world and life, COVID has only sped up the process of what was already occurring. So what we're looking at here is going all the way back to 2010, in blue for banks and green for credit unions, the amount of total deposits that was made up by certificates of deposits. So you can see the trend coming out of the last crisis was continually going down, so that the reliance on CDs was decreasing. And there was a little bit of a pause as we got into the rate hiking cycle in 2016, 17, and 18. And even credit unions did see a little bit of an uptick in late 18, early 19. And, from conversations we've had with folks, a lot of that was attributable to emphasis from the NCUA, looking for diversification of funding and interest rate risk mitigation. At that time, we saw a lot of 3% CD specials, oftentimes in excess of wholesale funding prices. But that decline now has resumed.
When looking at changes in the investment portfolio, current period comparing back to 3/31, what we sought out to identify was, given the low rate environment and the tight spreads, were folks extending into sectors that they typically don't invest in? And the short answer is no. Most members have maintained their allocation in their core sectors, MBS, CMO, agencies specifically. What we did find was rather interesting is that even with the phenomenal amount of deposit growth and the tepid loan growth, you would expect to see sharp increases in the investment portfolio in those core categories on a dollar for dollar basis. But when we look at the data, and that's what the chart on the left is showing, the number of members who either increased or decreased their exposure in those particular buckets. So in MBS, CMO, and agencies, where you'd expect to see most of that excess deposit funds go into, that we actually saw more members had decreased their exposure there rather than increase. And what that tells us is that it's been awfully difficult to keep up with the relentless prepayments coming off of those portfolios. So as prepay spike or calls happen, just simply reinvesting to stay flat, let alone grow, has been a challenging thing for members to encounter. Shifting to the credit performance of loan portfolios, and the trend continues to be okay. We saw the aggressive provisioning happen in the beginning of 2020, and those have been ticking down in the last 2 quarters, and we've even, in fact, observed some members who in the fourth quarter were able to release reserves through negative provisioning. So that's a solid sign on what the outlook is for credit going forward. Nothing out of the ordinary when looking at either charge-offs or non-performing assets. And when it comes to capitalization levels, even with the forced leverage, if you will, of the extraordinary deposit growth and the PPP loan activity that did lead capital ratios to dip down ever so slightly in 2020, capitalization ratios continue to be extremely strong. And the banking industry as a whole is well positioned, not just to participate, but to thrive in a recovery and economic expansion. And lastly, we'll take a look here at public bank performance. And I've said this before, that even if you're a mutual or credit union, looking at how the markets are pricing the banking industry can be instructive for a general outlook on the sector. And
The long story short is that the market likes a steeper yield curve and what that does for bank balance sheets and bank income statements. So here we have a index of the public members here in New England, as well as a broader national level, and then in the gray bar being the 2-year versus 10-year Treasury steepness. So you can see the relationship that as the yield curve has been steepening over recent months, that has led to a lift in bank stock prices as well.
That was good. Thanks, Andrew. So we're going to finish off today by walking through a few different strategies here. Everyone is operating in just a very atypical time right now. So even when you compare it to the challenges faced 12 years ago, and when you think about the ALM process, it really boils down to 4 main buckets when you're seeking return and managing risk. And those buckets are duration, credit, liquidity, and optionality. It comes down to first, what can your balance sheet support? And second, what are you able and willing to act upon? So if you look at the challenges and opportunities listed here, these are things that we see as key items and things we certainly hear from you as well. And we can approach these and looking at it from a combination of offensive and defensive strategies that fit your needs. And certainly, some of these are still very cloudy, but a few of them have become clear over the last 6 months. So we're going to talk about optimizing funding mix and cost. So we can walk through the impact on near-term CD roll-off and how do you use that excess liquidity to your advantage. So there are 3 main things that can happen as CDs mature. They roll at the rate you set, they switch to non-maturity deposits, or they leave. And in order to price these, you have to balance the intangibles of customer relationships, but you also have to optimize to financial needs of your balance sheet. So in order to illustrate this, we're going to walk through an example of 2 members. You have member A and member B. We think both of these members do a fantastic job of pricing deposits in coordination with their balance sheet and leveraging access to the wholesale market when they need it. So looking at member A's profile, we see they're a prolific lender as shown by their high loan quality score. Member B, however, has a fantastic deposit franchise as shown by their deposit quality score. These members have very different business models, capital levels, and geographies, but the common thread here is that they were able to normalize cash levels to pre-pandemic levels. How do they price deposits? So if we look at A as shown in the left chart here, remember this is a growth lender. So they're aggressive on CDs, even exceeding advance rates at 1 to 2 years. And so as lending ramps up, and if there's not enough traction with their longer duration offerings, they can come in like they did and fund with 1-year advances at 29 basis points. And then switching over to member B, remember member B has a fantastic deposit franchise. Their rates are very low across the board, yet they still bring in deposits because of their customer service, which is a very hard thing to quantify. So when the ebbs and flows of liquidity demand funding, they come in at 6 months to borrow. And with the current compressed yield curve, wholesale funding may even bring down costs. So you have these 2 members that have very different business models, but use pricing strategies that allow them to manage their balance sheet needs and liquidity in an effective way. So this chart here is looking at loan to assets and deposit to assets. No surprise here, loans have fallen and deposits have surged and kept surging. We're all hoping for second quarter return to normal in many facets of life, and including a resurgence of loan growth. As mentioned earlier, the question is, do I hold cash, wait for lending to pick up, or do I deploy it now at these uninspiring levels? And this is the benefit of wholesale markets. You determine the timing and structure, unlike with your loan and deposit books. So if your greater concern is deposits not being sticky and second quarter loan demand goes through the roof, you're likely tilting more defensive than the person concerned about persistent low rates and deposits aren't going anywhere. In terms of reluctance to investing in MBS at these low rates and spreads, we've been advocates of looking at defensive structures like 10-year and 15-year agency pass-throughs. While 50 to 100 basis point yield isn't great, the point of managing your investment portfolio isn't to swing for the fences. So on this page, we're looking at an example 10-year MBS and the natural cash flow it produces. And if you were to pledge this asset, you see that you are transforming your liquidity from cash on hand to an investment where you're able to, if there was an acceleration in loan demand or a sharp deposit outflow, then you would be able to access the necessary liquidity via just-in-time advances that meet your funding needs. Another thing to consider, given the drop in loan-to-deposit ratios, you can leverage the held-to-maturity designation if there's concern about price risk. Our analysis shows that many members are not utilizing this ability, even those that have very low loan-to-asset ratios. So we're looking at an earnings sensitivity profile for the defensive strategy we just discussed. For many, persistent low rates will lead to further decline in earnings, and even for those with some liability sensitivity, income hits with rising rates is primarily just in the first year or two. Then income recovers, as shown by the chart on the left here. And what you get in using some of that asset sensitivity to support earnings now, in moderation to the amount of upside for an aggressive upturn that you're willing to trade off. You can see from the simulation charts on the right, you lose some upside in rising rates, but are able to combat margin pressure in an unchanged rate environment. So this is a defensive play that you can use to help manage your balance sheet. So now we're looking at some quick hit for tools in the toolbox. Getting liquidity right through deposit mix and asset deployments is first and foremost right now. But here's some conversations we're continuing to have with members. Restructure and invest. If you have an existing advance on the books, say from 6 months to 2 years, you may be able to drop the rate on that and reduce interest rate risk. A lot of members have said, rates are so low, I'd love to borrow, but I don't need any more cash. And so this strategy is a way to do that. And pairing a restructure with investing excess liquidity can yield some very favorable margins and gap results. We've also had a lot more conversations and seen more activity around our SOFR index advance. This is a way to borrow a floating rate advance based off overnight funding, where, as we discussed, the Fed has clearly stated rates are staying fixed right now. Actually, just last week, we saw a 3-month term on the SOFR index. The day one rate was 22 basis points, which is about 10 basis points less than the 3-month classic rate. There's a real opportunity there to follow Fed guidance and reduce cost of funds. And as part of the LIBOR transition, there's some applications for advances in the derivatives market, such as cash flow hedge swaps. So please reach out, for more info there, and we'll talk that through with you. And the DNA floater is another variable rate advance. It has a great feature in that members can prepay with no fee at each reset. This is good if and when liquidity pendulum swings back the other way, but you want to fund at shorter rates. And then lastly, with conditions so calm, it makes you think about preparing for what ifs. Like in March and April of 2020, when things shifted, fast and drastically, are you ready to be opportunistic with the balance sheet if and when you want to? And I close out this section, please reach out if you have any questions on this or you want to dig deeper. We're always happy to discuss this and kind of look at this from your perspective and your balance sheet needs. We have a new website if you haven't seen yet. Please check it out. We've really redesigned it. The team has put in a lot of work to make it really easy to look through rates, look through strategies, and get information that you need. So we'd love the feedback on it. So please take a look at your convenience, and we'd love to hear about that. So with that, thanks for attending today. We hope you got something out of this. And like I said, please reach out if you have any questions at all, and we're always happy to talk. Have a great day, everyone.